Retirement Podcast, where we share real-life stories and strategies that we've used to help hundreds of families retire with confidence. Your host is certified financial planner Jim Cox of McCarthy Cox Retirement and Estate Specialists. McCarthy Cox embodies small-town midwestern values and is dedicated to building better tomorrows.
Well, welcome everybody to another episode of Toast to Retirement. My name is Jim Cox, and I'm the managing partner of McCarthy Cox. With us today is my partner and friend Ryan Michelson. Ryan's been with our firm for 16 years now, which is, that there's a couple moments like where you kind of look at this and you just go, "Holy moly, has time flied!" Right? I mean, we've been through a lot together. We've seen the firm grow. You were the third person here, or fourth person here, I guess.
Third advisor. I think I was
employee
number 5 or 6. I don't remember, but.
And it's been an awesome journey, and I'm thankful for you to be my friend and partner.
Likewise.
We've done a lot of great things for a lot of people, by the way. Yeah, I think so. I hope so. So Ryan's here today because he's passionate. He asked for this topic. This is his topic. He does this all the time. And the topic today is Roth conversions. So before we go any further, a couple of things I need to talk about. Number one, we are not tax accountants. We do not do tax returns. What we do is we try to advise clients on tax minimization strategies. And a lot of times we will do that in conjunction with your CPA or tax professional. So also, we're recording here in September of 2025. So what we're going to talk about probably has some specific timeline, numbers in it that may be changed by the time you're watching this, because I anticipate this being watched for generations to come.
Of course.
Quick advertisement, because you don't know how long people are going to watch. McCarthy Cox, this is our 26th year in operation. We are located in a town called Marysville, Ohio, which is just about 20 to 30 minutes outside of Columbus, which is central Ohio. However, we've grown over that period of time to have, I believe it's clients in like 26 states now. So
is it that many?
Yeah.
Wow.
So we're not like national necessarily, but we're not far off. So
yeah.
But we've always, our tagline is we embody small town values, and are dedicated to building better tomorrows. Well, the small town values, what does that mean? The golden rule, right? Do unto others as you would have done unto yourself. And so, taking care of your neighbor, right? Small town value. The topic today that we're going to get into is Roth conversions. Before we jump into that, I want to give a very high level. I don't know who's listening, right? Some people this might be a little bit too rudimentary for. Others it might be enlightening. Just a simple discussion between what a traditional IRA or 401k contribution looks like versus a Roth IRA or 401k contribution. And there's going to be a graphic that I made. I spent, 3 to 4 hours on this yesterday. That's a lie, but so on the one side of the screen, you're going to see traditional IRA, and then on the other side is going to be Roth IRA. And the illustration here is a $10,000 contribution to both. On the traditional IRA, if you make a $10,000 contribution, it's tax deferred, so you don't pay any taxes for that. Likewise, on the Roth IRA, if you put a $10,000 contribution in, you do have to pay taxes. Taxes are owed up front. So what we're going to assume here is that we are in a 25% tax bracket. So the equivalent dollars invested on the traditional IRA or 401k side would be $10,000, and the equivalent money on a Roth IRA or 401k would be $7,500. All right. So now we're going to skip forward for about 10 years, and the rule of 72 tells us that $10,000 investment on the traditional IRA or 401k side would grow to about $20,000, and the equivalent on the Roth IRA side would then, of course, the doubling, right? So Rule 72 would grow to $15,000. So, at first blush in that 10-year time frame, it looks like, you got $20,000 in an investment versus $15,000. So which one's better? Well, right there, that looks like, the traditional would be the way to go. However, that being said, when you withdraw that money, so the money is just the ability to, do the things you want to do or like to do or need to do with that money, right? So what do you get when you take the money out of the tax shelter? Well, on the traditional side of things, let's just assume that you're in the same exact tax bracket. So you're at 25% tax bracket when you take the money out, which is, let's say, the same as what you put the money in. Well, on the traditional side, you owe $5,000 in taxes then, right? So what do you net? You net $15,000. Well, look on the other side. The Roth, which grew tax-free for that period of time, is you get to take that out tax-free. They're mathematically equivalent, right? This is what, and maybe just showing people this is like, because I have had clients come in on multiple occasions that have been like, oh, this tax loophole of the Roth, I really want to take advantage of that. The difference of what you should do, whether you should do a Roth or a traditional, comes down to
your tax bracket, the rate that you've got to pay now and potentially pay later.
Right. Analyzing today's tax rate when you're putting the money in versus what your tax rate is going to be when you take the money out, right?
Right.
So it's not magic. It is math, which is why they allow it to happen. That being said, there are planning strategies involved with this that we can, with these rules that exist, we can really create some amazing outcomes in tax minimization strategies. I know you and I both share a passion for minimizing taxes. I've seen your whiteboard in your room, and you're walking through the tax brackets with everyone, and so we with that basis of understanding of what the difference is, let's talk just a quick minute about the history of Roth IRA, Roth 401ks.
Yeah. So if you don't mind, I'll start
out.
When
and
was
you
it
can jump
in a minute? Yeah. So it's actually relatively recent as an option for how to save for retirement. So there was a Taxpayer Relief Act that was passed in 1997. So it became effective for 1998 was actually the first time that you could make a Roth IRA contribution. There was the ability to do conversions as well, which we're going to talk about conversions here in a little bit, but that's moving money from a pre-tax account to a Roth. And that was limited based on your AGI, your adjusted gross income. Had to be $100,000 or less, or your conversion ability was limited. Also, for new money going into a Roth, I don't actually know what the specific limit was back then, but a lot lower than today.
Yeah,
maybe
right.
$3,000, $4,000 a year was the most in terms of new money you could contribute at that point. So that was the genesis of the Roth IRA as an option. In 2001, there was some other legislation that passed that allowed for Roth contributions to be made inside of a 401k or an employer-sponsored retirement plan, so that broadened the ability to make contributions if you were working for an employer.
Yeah, and then then you skip forward almost a decade, right? And in 2010, they eliminated the 100,000 AGI limit for conversions.
Yep.
That's when conversions first started really being talked about in the financial planning world, in my experience anyway. But it was still very, I don't know, academic. I don't know that we did a conversion for a while. I think conversions have really become significantly more popular in the last 5 to 10 years. Part of that is, we've got things like the first phase of retirement plans was all pre-tax contributions, right? And Roths, like you said, they just came on board, in the last 15 years or so, and corporations were slow to adopt them. I didn't see hardly any clients retiring with Roth money until really maybe the last 5 years. You agree with that, or what was your experience?
Yeah, well, even though the option was created for 401k Roth contributions a long time ago, I don't think employers started to pick up that option until maybe 15, possibly as short as 10 years ago is when we really started to see that option on a widespread basis.
And now they can do Roth contribution matching, right? But they, in 2022 or something like that, they made that rule that now employer can match the dollars. For a long time,
match was pre-tax, even if the contribution was Roth initially.
So now they can do that, but I still don't see that. Do you see it yet?
Not really, no.
No, so it's
on the employer side, no.
Yeah, on the employer side. So it's an interesting thing. Like even though it becomes law and the taxes change and everything else, it takes a while for this stuff to gain momentum, and probably because employees need to push for it, maybe, on the executive side or something. So anyway, it's been a relatively short period of time, like you mentioned, but one that's gaining more and more speed, importance, and I would even say just people are talking about it more. I don't, how Google's listening to you or whatever, like Facebook or something. So I was like scrolling on my Facebook page recently, and a podcast. I listen to podcasts as well sometimes, but a podcast came up about Roth conversions. I was like, wait a minute, how do they know we're going to be doing one of these? So anyway, There are other ones. I mean, I don't know. They're probably not as good as ours, but the idea of living, tax-free in retirement is attractive, right?
Sure.
So let's really just get down to the meat of this. Who should look to do a Roth conversion?
Yeah, so I think for our clients anyway, anybody that I work with, it's an option that we're going to look at for everybody. Mm-hmm. Now, it's not going to make sense for everybody, but I think it's going to be an important or an integral part of lots of people's retirement plans at this point. And as we mentioned, it has to do a lot with what your income situation looks like already, and then what your expectations may be for your tax rate in the future. Obviously, none of us knows that, but I think we would agree we have a pretty favorable tax setup right now, mm-hmm. right? And so we may be in a window of opportunity to take advantage of some of the current tax rules to position ourselves for whatever may come in the future. That's kind of the lens we look at it through. So the lower your current tax bracket, the more attractive this option may be. Also, the more you may be inclined to think things are going to go up from here tax-wise in the future, also the more attractive.
Like, I've got some clients who's politically, that politically might be the wrong word, but because of the debt of the country, right, and the worry about how do we pay for that debt, there's a lot of economists that say that taxes have to go up. And if that's the case, then, taking advantage of the lower tax rates right now might make sense. There's a lot of reasons taxes could go up. Tax rates could go up, right?
Right. Well, there's also some reasons within a certain person or household situation that might cause their tax rate to increase, right?
Yeah.
Certain events could happen to take that rate north of where it is today.
Well, we work primarily for people very close to or in retirement. We specialize in that. One of the things that we have to know, like the back of our hand, is required minimum distributions. For a lot of people listening, that's going to be age 73 if you're probably already in retirement. For those 65 and under, I believe it is right now, that is age 75, that you'll have required minimum distributions on top of your Social Security distributions, on top of any pensions that you might have. Those RMDs can push you into, depending upon how successful you've been with your investments, and if you've tried hard to save for your nest egg over time, right?
Yeah.
That can push you into a higher tax limit. That's what I've seen.
Yeah, for sure. I would say a majority of our clients come to us with the majority of their retirement savings in pre-tax accounts, right? So those all will be subject to those RMDs that you just mentioned at either 73 or 75. And so for some folks, they're already using their 401k or IRA for income currently. They may not have to make much of a change as far as how much they withdraw when they get to that age. But for a lot of people, let's say they have pension income, let's say, both worked under Social Security or both have pensions, and the recurring income is already strong, they may have, when they get to that point, a lot more money that's required to come out than what they strictly need to live on, and the tax rate goes way up. So that's the kind of thing that really makes this conversion strategy attractive, I think.
A lot of people I've found too, when I'm explaining it, there's still this bias that get the tax deduction today. That's still the bias, and I would say the majority of people, and I think that's just drilled into us from, every accountant that we've ever, every tax preparer that we've ever met with. They're get the tax deduction today. We don't know what is going to happen in the future. One of the ways that I've kind of helped people illustrate this, and we do have tax software, things that do kind of show what will happen in the future under some assumptions, of course. But one of the things I do is I kill one of the spouses off. Usually the guy. It's just how you
don't pick on the lady. Yeah. It's common courtesy.
And if they're married, of course, and filing jointly, well, then you double that tax bracket, right? Well, what happens when, one spouse passes away? That full required minimum distribution is still required,
Right.
even though only one of them's alive.
Right.
So their tax bracket's in half, but their income is exactly the same. I mean, you'll lose one Social Security, let's say, maybe one pension or a little bit less than a pension. But for a lot of people, they don't think about that.
Mm-hmm.
And all of a sudden now the widow or widower is paying significantly more taxes than they have really their whole entire married life. And, that's just not something that, nobody really wants to think about that. It's kind of our job as professionals to just highlight, so that's an advantage of doing a Roth conversion maybe, and taking advantage of the current bracket that you're in relative to the bracket that you will likely be in the future.
Right.
And then what about the next generation?
Yeah. So a lot of people, hope to have money left over that they don't spend during their retirement. In fact, that's a huge part of our planning work, is try to make sure that people have something left when they're gone. But for those who will be leaving something behind to their kids or grandkids or whoever, well, there's a distinct possibility that by the time that inheritance happens, that receiving beneficiary might already be in one of the higher tax brackets. Under the current rules, if you inherit a pre-tax retirement account and you're not the spouse, you have a maximum of 10 years to deplete that balance. So in simple terms, if you inherit an IRA and there's $1 million in there, you have to take roughly $100,000 a year out to get that money all out in the 10 years. So that could really impact the tax rate and bracket of the heir who's getting this stuff. And so one of the considerations, again, with Roth conversions is you're prepaying the tax for their benefit, potentially, in that case. Strategically, at a known rate, you're deciding, hey, I'm going to pay the tax on this chunk of my retirement money, and whether I use it in my retirement or whether I end up passing it on to my kids, it's going to be tax-free either way.
I have that conversation when I go to that level. It's kind of split down the middle. It's like, well, it's not my intention to leave them any money. Whatever, they'll just have to pay whatever taxes, and I'm not paying them. So, I've had that before. In some circumstances, though, and probably half the circumstances, I do have people who look at it and they go, realistically, there's going to be money left over, and I'd rather my family get it than the government.
Yeah, absolutely.
And so for those folks, then, the conversion strategy is even that much more important. But
one other quick comment, if I can.
Sure.
I get the question pretty often when I'm meeting with somebody, new to us, just starting out a relationship that says, well, should I be making Roth contributions now, or should I be doing Roth conversions now? And this person may be still working, maybe at the highest point of income in their career, right, at the tail end of it. And in a lot of cases, because of what tax bracket they're in with that working income, it doesn't necessarily make sense. But one of the things we like to look at is, well, once they're retired and their income goes from here to here, now maybe that window opens up and there's an opportunity, right, in a lower bracket. So sometimes waiting until life event happens and your income at least on paper looks less, that may open up a window for you.
Well, I'm just gonna. I mean, I know we have somewhat of an agenda that we're looking at, but I'll skip forward to the time of your life and the income number kind of dictates what you should do, right? So like phase one of your career, 9 out of 10 times is going to be the lowest income that you're going to be living on, right?
Hopefully.
Yeah, I mean, that's the whole idea, is that you build a career and you make more as you go forward. And, now a lot of our existing clients didn't have this option because the Roth didn't exist when they started out. But if you have kids or grandkids, encourage them to their first retirement, plan contribution should be Roth. In fact, parents that might want to help their kids get to that next level, if their kids are working, even at age 16, 17, 18, you can make a contribution, if they have earned income. So that's the key. You have to have earned income, but you can make a Roth IRA contribution. And think about that. You give a 16-year-old, $4,000 or $5,000 if that's how much they made in the summertime, and what that would grow to with the rule of 72. If they with a growth portfolio over a 40-year period of time. I mean, it's even for maybe not parents and grandparents have the same enemy, their grandkids, but I said it wrong. Parents and grandkids have the same enemy, right? No. Grandparents and grandkids have the same enemy. I'd get that right if I knew the joke. I'm actually stealing somebody else's joke, which is Tom McCarthy's joke. But so sorry, Tom, I butchered that. You're much better at that than I am. Regardless, grandparents might want to make a contribution to the grandkids. That's a really cool idea that I've had people do if they're so inclined. So let's talk though through. Let's just give one example, like a no-brainer example. We've done, I don't know, I've done dozens a year of these. You do dozens a year of these. Somebody like maximizing their current tax bracket. Let's say the 12% tax bracket.
Yeah. So to your point, I feel like each successive year over maybe the last 7 or 8, I feel like we've done more of these collectively as a firm.
For sure.
And part of that is awareness, like you spoke about, and part of it is the tax environment we find ourselves in. But to cut kind of to the chase and give an example.
To be fair, we also thought, I mean, the current tax rates we thought were expiring this year.
They were going to expire.
And they were all going to go up at least 3%. And with the debt of the way it was and everything else, we thought there was no way that the taxes wouldn't go up. But here we are. They did make the tax rates permanent. I love it. Yeah, permanent until the next administration or whatever decides that they're no longer permanent. But
right. So the tax rates and brackets are here to stay for the foreseeable future anyway. So we can work with them at least for the next few years. But to give kind of the example, so let's just say for the moment that a couple is retired and filing a joint tax return. The way things are currently configured, the first $23,000 of your taxable income after deductions is taxed at 10%. So not too many of our clients are going to find themselves in the 10% bracket. If you can live on that kind of an income, great, but most people can't. And so the next bracket after that one, though, is 12%, and it goes from $23,000 of taxable income up to almost $97,000. $96,950 is the actual number. So, and again, that's after deductions. Now, the standard deduction this year, with the one big beautiful bill in place, is $31,500 for a married couple filing jointly, and then there's some additional deduction if you're above 65.
65, right?
You can get to about $46,000 of standard deduction.
$46,000 standard deduction for the next couple of years.
No itemizing, nothing. Just
over 65.
Right. If you're both 65 and you file a joint return, $46,000 off the top. So you make $100, your taxable income is $54,000.
Wow.
So it knocks off a bunch of that income. So it just creates even more of an opportunity potentially to do the Roth conversion. So the no-brainer, as Jim referenced, is kind of maximizing those lower tax brackets and taking your taxable income up to or very close to the line where the 12% bracket ends and the 22% bracket starts, because that's the next one. And that's a pretty big jump, right? A lot of people are not happy, but would pay taxes at 12 cents on the dollar, not feel too bad about it. When you go to 22, it hits different. That's the biggest jump in the whole system, and I would argue probably affects the most people, or most people are kind of flirting with that line.
And right above that line starts some other, what we call gotchas.
Yeah.
Right? So that's a classic, I think. If you are finding yourself in that 12% bracket with the new tax deductions and everything else, it's kind of a no-brainer, right? To do a Roth conversion. If that works for you in your bracket. You got to consult your tax person or come in and talk with your financial advisor. But so speaking of gotchas, right? Because there are some gotchas. Can we talk a few? What you've seen? Yeah.
So there's a couple that are pretty obvious, then a couple that are maybe not so obvious or don't apply in all situations. But you just got to make sure that you're not facing one of these things if you're looking at doing conversions. So one would be if you are above 65 and on Medicare. With Medicare, there can be higher premiums if your income goes above certain levels. So the acronym for that is IRMA. It's income-related adjustments, and they're up there pretty good. So unless your income is already pretty high, you're probably not going to be flirting with those IRMA thresholds, but it's something to bear in mind. Along the same line,
they would start somewhere in that 22% bracket, though, right?
Correct. Yeah. Your taxable income would already have to be well up into that 22% bracket before the IRMA thresholds would hit. On the same line, for somebody who's not yet 65, not on Medicare, and maybe not covered by an employer plan, So individual marketplace type insurance that's subsidized.
So retired without a retiree health care plan. Something like that.
Right. Yep, that kind of scenario. Those premiums that you pay are, of course, income related, or you get a subsidy that's based on your income. And so if you've put a income target out there, which generates a certain subsidy, but then you do a Roth conversion and your income goes way up from what you projected, now you could find yourself paying a higher premium for that health care through the marketplace.
Then there's things like, how much you pay in capital gains, right? I mean, they take all your, any Roth conversion is taxed as taxable income, so it's added all together, and your capital gains are added in there to determine whether you pay capital gains or not, and there's thresholds there, usually right above that 12% tax bracket. As long as you stay in that 12%, then a lot of times you're okay, which is why that's the no-brainer part of the discussion, and then it gets a little bit more complicated. I've done conversions higher than that. I don't want to say that it's not, if you're used to being in a much higher, if your expectation is you're going to be at a 35% bracket or something like that in the mid-30s, like, why not? Then let's talk about getting up to as much as we can in that 22. But so the other kind of, I don't know if this is a gotcha. It's more of just a consideration, in my opinion, is, when you do the conversion, you got to pay the tax. Can you speak a little bit to like the best way to pay that tax?
Yeah, so there's essentially two ways that you can cover the tax that's due on the conversion. The one is you can withhold taxes in the transition. So basically when the money moves from the traditional IRA, 401k, kind of over the tax fence to the Roth, you can have money withheld off the top. Just like if you were taking a distribution or that kind of thing. Where that's maybe not as advantageous is, of course, a chunk of the money that was in your retirement accounts is now not there to keep growing and working for you. So ideally, depending on your situation, if you have cash on the sidelines in the bank or whatever that you can use to pay the tax due on the conversion, that's really ideal because that preserves the whole amount. If you convert $40,000, a whole $40,000 goes into your Roth IRA and starts working for you from the moment that conversion happens.
Versus having to pay like $5,000. It's only getting $35,000 into the Roth because you have to pay $5,000 in withholding, right?
Right.
Yeah. So plus, if you think about it, that what you've done is convert post-tax money, right? So if you have cash in the bank or whatever, that every year that you earn interest on that, it's taxable, right?
Yep.
So that just adds to your tax bill. And if you can take that cash, put that to pay the taxes, that's the equivalent of then converting that money to Roth now to be tax-free.
Absolutely.
So all of those are, and then one more gotcha that came to mind was just the idea. This is with any Roth contribution, there's the 5-year rule, right? So we need to wait 5 years to be able to take the money out, not the converted amount, but any growth amount that you get. We want to wait 5 years for that tax-free to actually happen. You got to wait 5 years. Otherwise, you are going to end up paying taxes on the growth and a penalty, I believe, if you get it out within that 5-year period. Is that correct?
Yeah. So the two stipulations for getting the gains out tax-free are, number one, you got to be at least 59.5 when the withdrawal happens, and number two, the 5 years have to have elapsed. Now, that's not. Let's say you have a Roth account, you contribute to it in successive years, multiple years. Well, it's 5 years from the date the account was opened, not from, not that each contribution carries its own 5-year waiting period.
That's
just
a great
to be clear.
Point. Yeah,
so
right.
That's one. And then the other would be in terms of the principal coming out and so forth. The accounting method that they use, if you take a Roth distribution, if you take money out, is first in, first out. Whereas,
FIFO. Okay.
as my southern econ teacher would say, FIFO.
FIFO.
So first
Tony
in, first
Dalton.
out, meaning the contributions are deemed to come out first. So if you put in 10,000, it grows to 12. You pull out 10,000. What's deemed to come out is what you put in. So that's how it's accounted.
So you can, theoretically, you put money into a Roth. You put $5,000 into a Roth. You can get that $5,000 out.
No tax, no penalty.
No tax, no penalty.
Anytime.
A year later,
Yep.
You just can't get, if 5,000 grows to 6,000, you can't get that $1,000 of growth out.
Right.
For 59.5 plus 5 years.
And I would say that's an emergency step, right? If you thought you were going to pull the money out inside of 5 years, anyway, we wouldn't even recommend you do this.
Right.
Because really the strength of the Roth is time, right? Compounding over time.
Great.
Tax-free compounding over time.
Great segue.
Hey.
Right. You've done this before. So we're doing a conversion, right? We took pre-tax IRA or 401k money. We made it into Roth. What should we do with it?
Yeah. So one thing that's kind of funny that I've seen, and no offense to anybody that's had this scenario, but I have encountered Roth IRAs held like at the bank in a money market or a CD, which is okay, I guess, but your growth potential on those types of investments is really limited, right? So if we're talking about trying to compound growth over time, it ain't going to compound a whole lot. So the real strength of a Roth is, as I mentioned, time and compounding. And so we would argue that within a portfolio, in almost every case, we would recommend a growth allocation, stock market heavy type allocation, or at least as much risk as someone is personally willing to bear for that Roth account. You want to give that account some horsepower because, again, if it only grows a little bit, you're not getting a whole lot of juice out of the lemon, so to speak. So we'd say, the Roth, in most cases, is probably going to be the most aggressive account you have. Would you agree with that?
100%.
Yeah.
Yep. It's always that third phase of retirement planning for us. Yep.
Yeah. And the classic example is, the guy that founded PayPal, right? I can't remember his name off the top, but he opened a Roth IRA. He contributed $3,000 or whatever, after tax, whatever the limit was at that time, and he bought PayPal stock with it. Of course, PayPal, with its association with eBay, the stock went through the roof. And that Roth account, which started at $3,000, was worth millions, maybe even billions of dollars because of the growth, and it's all tax-free. All tax-free. So most of us probably aren't going to get quite that lucky. We can hope, right? But the concept applies that if you're going to take risks somewhere, absolutely take it in your Roth.
We talked about the career path. Younger in your career, put money into Roth. Later in your career, you're likely going to be at a higher tax bracket than you're going to be in retirement. So most likely you should do your traditional and tax write-offs at that point. One more strategy I think that I've kind of tried to get people to adopt that are younger, that are putting out. Don't just put money for retirement into your retirement funds, okay? Either you can make max contributions into the 401k, like above non-tax deductible contributions. You can do that, or you can just do an after-tax investment like brokerage account, and just systematically put money into that over time. Why? Having the ability to, before, let's say, you turn on Social Security, before required minimum distributions start, before your pension starts if you have it, you have this ability, if you can craft it. If you can't, some people can't, but if you can, it's super powerful. Live on after-tax money, right? So then your taxable income for that year is, let's just say, the interest that you earned at the bank, right? So you're pulling money out, you're living on that. Then what you can do is remember we talked about that 12% bracket, right? So let's just say, for easy math, you do $100,000, right? You could do a $100,000 conversion if depending upon what your lifestyle is and how long you can make it last. But if you plan it right and you have enough after-tax money, you can craft a really amazing. Can you imagine getting $500,000 or $1 million over into a Roth? That now you're talking. Now we're not talking, $10,000, $20,000, $40,000. We're talking impactful dollars to your family, and that whole inheritance. 10 years later, it's tax free for them for 10 years.
Yeah,
right. So you're talking your life expectancy for husband, for wife, 10 years beyond for the next. I think they're talking significant, amazing, transformative wealth for generations. And it's just a great strategy to have if you can make it, if you can pull it off. Not everybody can, because the 401ks and the corporate retirement plans. A lot of people are putting what they can into those. But if you are blessed to have the ability to save a little extra, it's okay to save some in an after-tax account and implement this type of plan. Takes years in the making. Sometimes people are lucky enough to get paid out like at retirement with a lump sum type option, with cash option type of a situation, but and we'll make that work. Or perhaps, by the way, too, inheritances sometimes come in the form of, if you sell mom and dad's house, something like that, you can have cash, and you can maybe back off of your withdrawals from your investments and live on tax for a year. I think you kind of brought that up earlier, with changes to life, unexpected changes to your income can dictate future options as far as planning is concerned as well. All right. So
can I throw one more little example on that? Just as what you said, because it made me think of something. So, along the lines of life events presenting opportunities, and just something to be kind of, have your antenna up for. I have a client who, long story short, inherited a farm operation and basically got to take a whole bunch of bonus depreciation all at one time.
Oh, yeah.
And so wiped out all the income he had for that current year and for several years after that because of carry forward. And so effectively his taxable income was negative.
Wow.
And so it presented a massive opportunity. What money he had in pre-tax retirement accounts immediately became fair game for these conversions. And to your point, we could do it at significant amounts. And so we, over the next few years, are going to be able to get pretty much all of his pre-tax money into his Roth.
That's awesome.
Because of the depreciation. So when something, I don't want to say weird, but unusual like that comes up, it really can present an opportunity.
We've been doing this long enough. I have 2 clients that have officially moved to 100% tax-free. I don't know.
That is sweet.
I know. It's just one of those things that you go there's plenty of people out there that are dealing with their financial advisor. They talk about their investments and they go home. If I'm not saying that's everybody. But tax minimization strategies are something that gets our blood going. It's something that there's so much of our job and our role as advisors that we can't control. We can't control global markets and economies and stock market and all that stuff, right? And so we have ways of navigating through it, but this is something that you go, okay, through actual planning with math, you can actually make a significant difference in the lives of your clients and their families. And so just taking those types of opportunities, I think, is super important and kind of elevates you as an advisor.
So let me throw one back to you then. How do you know if you should do a conversion or not? When do you determine that in a given year? What's the process look like?
I think it starts with having a trusted advisor that can walk you through it. I'm assuming I'm talking to non-financial advisors on the you know what I mean? if there's other, if
they are advisors, they're already
there are other advisors going, oh, I never thought about that. No, so yeah, it first starts with, hopefully you have a financial advisor. If you don't, you should get one. And there's performers that you can run. We have not tax software. It's tax minimization strategy software that we implement and kind of put all your data through to kind of analyze. It's part of the comprehensive package, right? Where you go, okay, it's kind of it's almost like an overlay, right? You go, okay, here's what we have to do to make a retirement work, right? Here's how much income you need. Here's the sources that you got. Here's how we can design it. Now, let's do an overlay of a tax minimization discussion and strategy. Are there areas that we can, add value at that time?
Yep.
You agree with that, or?
Yeah, for sure. It's kind of a second tier thing. It's not necessarily going to make or break a retirement, but I would say it could optimize a retirement, both for the current generation and maybe the next one.
Right.
And so what I like to do is usually late in a year is take a look at this, right? Because
you're saying
with a specific
year.
With a specific client, household or whatever, you don't know necessarily what's going to happen all through the year, and so one year might look different from the next, income wise and things. And so with my clients, I like to take a look in the fourth quarter and go, okay, what income have we seen this year? Again, none of this is we're not doing a tax return, but we're trying to pretty accurately ascertain what kind of income they've had, what deduction they might be looking at, and things like that. So we have an educated basis for making a decision about, number one, do we do a conversion? And number two, how much, if so? And the idea is usually, again, get up to within striking distance of that bracket line without going over if we can help it, leaving some wiggle room for what ifs, right? But if you do it with 10, 11 months of the year gone, there's not as much that could happen to kind of throw off your numbers.
And you can have, on your taxable, let's say you have a taxable investment account, that you can usually run a pro forma of what the expected capital gains distributions would be for that taxable account that year by then. Yep. Just tying down those uncertainties of income. You could have somebody who, unfortunately, one of their loved ones passes away and they get an inheritance, and you have all this tax deferred annuity money that comes in, and you did conversion earlier in the year, and you end up hurting a client for that. So
Yep.
usually it makes sense to wait unless you have that financial plan in place, where somebody's like living on after-tax dollars or something like that you can
Yep.
make work. But,
Yep.
all right. Well, we anything else you want to? I mean, did we miss anything?
I mean, there's lots of other nuances to it, but I think that's the general nuts and bolts. And I think I speak for both of us when I say we both get excited at the opportunity of doing this with people, because it does make a difference. And none of us wants to give the government at the federal or the state level more than their fair share.
Right.
We're not here to dodge anything. We're not here to do anything illegal. But we're here to use the current tax code to try to get the best outcome for the client.
For
and
sure.
that gets us excited.
Yep. And like I said, it's something that you can actually control, right? Versus
Yeah.
a lot of the stuff that, well, we think this is going to happen.
It's like people buying toilet paper during COVID, right? It was like the thing that they could control. I know I'm not going to run out of toilet paper.
That's, yeah. Roth conversions are your hoarding of toilet paper. I didn't think we were going to go.
Sorry, I just kind of took a left turn there.
All right. Well, the name of our podcast is Toast to Retirement. And so I always let our guests pick what we are going to toast with. We've had things from pressed fruit juices. I'll leave that there. To we had champagne one time. We had wine. We had so what you need to know about Ryan is a coffee connoisseur. I'm not going to use the snob word. I won't use that. Other people have. I've heard it, but I'm not going to do that. That's not right. He's a connoisseur of coffee. He loves very good, high quality coffee. You also collect pens, right? Too.
I do. I have some pretty obscure interests.
Well, he's very cool. Like when I do something meaningful, which is once every 4 to 5 years, he'll write me this very beautiful. Like his handwriting is amazing, and I very much appreciate those, by the way. So, let's.
Yeah.
What'd you bring in today?
What we have here is some Ethiopian coffee, or at least
Okay.
that's the origin. This is a good batch. It's roasted by my friend Jeremy, who is here in town, and quite the pro on his own right. And so this has been something I've been drinking lately, and I don't know how much you
Is
love
Jeremy
coffee or don't love
in
coffee.
business of it, or is he?
I mean, it's more of a private
Just a
thing,
private
friends
thing.
and family
Okay.
kind of thing.
Okay.
But yeah, it's really good stuff if you like black coffee. I don't know if you're one of those guys that has to put the cream and sugar and stuff in it.
No,
it
I'm
may not be your bag.
I'm a regular bold black coffee kind of guy.
All right,
so
well,
I'm
you
gonna
should like
it.
this then.
All right,
so
let's try
yeah,
it.
let's go.
We got a coffee carafe. It's official. Now the question is, this going to burn my face off when we do a toast?
Bend it in there for a little bit. Should be okay. All right.
All right. So, ChatGPT helped me once again with this one. It's sort of good. I kind of like it. I also didn't want to spend 5.5 hours on it. So
Yeah.
it plays in this whole field. But
Let's have it.
to death and taxes, both are certainties of life, but one doesn't have to be as painful as the other. Here's to compounding wealth and lower taxes. Cheers, cilantro.
Cheers.
We go like that. There we go. For the dead ones. It's still warm. I don't want to chug it. Yeah, that's not bad at all. Hold on. Okay. What do you smell? What do you taste when you?
So Ethiopian typically has some fruit. This one is not as blueberry as some that I've had from there, but there's definitely some fruit note. There's a little bit of acidity, which I like. It's that kind of back of the tongue, like if you have vinegar or lemon juice or something like that, you get a little bit of that, like makes your mouth water. So I like that.
Yeah.
And then this is pretty full bodied too. So
Everything
I don't like
he
a real
just said is
thin-
on point.
I don't like a real thin coffee. I like one that's got a full body to it. So this is kind of all of that.
I like it. It's good.
Good.
Yeah. I appreciate your time, my friend,
It's been
partner.
fun.
Thank you very much.
Yeah, absolutely.
Great job. You don't know this because it is recorded, but this was a one take kind of thing. You might note it. I don't know. I don't know how many gaffes we had, but it was a lot of fun, and we'll see you next time.
Cheers.
Cheers.
Feel free to share with friends and family, and follow McCarthy & Cox Retirement and Estate Planning Specialists on Facebook and LinkedIn. Check out the podcast tab on our website, www.mccarthyandcox.com, where you can find links to all the episodes of Toast to Retirement. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general information purposes only and does not constitute either tax, legal, or financial advice. Please consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.